Hey, everybody. This is Kevin again with Leading Edge Financial Planning. Today, the pilot guides to real estate investing, taxation. So I'm going to go dig into the world of tax. If you're not interested in tax, but you want to be a real estate investor, I would just suggest you might consider one more time getting a little bit interested in tax because it is a tax preferenced area, and that is one of the reasons a lot of people do go into real estate investing. If you do like these kind of videos, please give me a thumbs up. Just let us know. These real estate videos, I know you really need to be interested in it for it to be interesting at all. So I would love any feedback that you have. So the statement that I would make to start out is that only go into real estate investing for the tax benefits if you expect to get real estate tax benefits and not overall wealth tax benefits. Like it's going to lower your flying income because the real estate, most of the time, it's not all of the time, but most of the time, when you invest in real estate, the investment in real estate itself will be tax preferenced. But overall, it's not going to really help you save taxes on your W 2 income, or if you have a W 2 and your spouse has a 1099, it's not going to really help with that. The only time it really helps is you can lose money on real estate if you make less than $150,000. If you're a real estate professional, which is very, very challenging to do, and or you have a short-term rental, you're using what's called the short-term rental loophole as far as, and maybe taking a bunch of depreciation up front. But for the most part, if you're going to do long-term rental real estate, the benefit is really in the real estate piece of your financial life. And so anyway, I think that's really the most important thing to know. So two types of income typically from real estate, rental real estate income. The first is that you receive rent, so everybody knows about that. Now, this is where the tax code comes in and makes it a preference item. And I'm going to share a Schedule E, which is where rental real estate goes. You never thought you'd be looking at one of these, I'm sure. Looking at my Dream Drive, Anywhere USA, this is just an example of this rental income and the powerful nature of depreciation during the years when you receive rent. So in this case, you're receiving $36,000 of rent, for example. These are your expenses. These are real expenses. And what I mean by real is that you're paying the money each year out of your pocket. And so when we come down here, we see the taxes, the real estate taxes. You got to pay the taxes on the property. You got to pay some of these other expenses. But when we come down to box 18, uh, this is the depreciation shield. So you can see that there's $18,000 of depreciation shield. What is that? Well, you bought the property for a certain amount of money. You cannot depreciate the land, but you can take an expense year in and year out. You can take an expense called depreciation against your rental income. This is the tax preference. This is the depreciation shield. So you see that this person, $36,000 of rent, but they have a loss on their tax return. I lost money, 6,482. Is that a good thing? Well, I didn't really lose money on the rental. Cash on cash, I received this amount of cash. I paid this amount of cash out. You actually made money, but this depreciation shield is what's known as a phantom expense. So this is the tremendous benefit that is the depreciation shield. Okay, so let me now come to another diagram, and what you can see here is that the real estate has a firm line here. It's segregated from the rest of your income. So yes, the rent minuses the expenses equals your profit. The depreciation shield will make a negative balance, and you made money, but the tax return says you lost money. Now, you cannot take this loss typically unless you have less than $150,000 of income. Most pilots don't have that. You're a real estate professional. So that's just carried forward. But I made money, but I don't have to pay tax on the money I made. That's the part of real estate that's great. The part that's not so great and this is the part where there's a lot of misunderstanding, is I'm flying for, let's say, Delta, and I'm getting paid a big amount of money from Delta because I work really hard. I'm away from home. It's not an easy job. So I get my ordinary income. You can't take this $2,000 and move it over and lose that 2,000 versus your ordinary income. It doesn't work that way. 1099, you have a side hustle. Spouse has a side hustle. Once again, you have your income minus expenses equals net income. It's ordinary income. You cannot deduct real estate from there. Bank interest, bonds interest, ordinary income. IRAs, 401ks, pensions, if you have a military pension, ordinary income. Now, the stock funds and dividends and long-term gains, they are taxed a little bit differently. And when we get into the sale of your real estate, long-term gains, these losses here can offset the gains. But there's also a big issue with when you sell your real estate. So let me stop sharing there and just say, so the first type of income is the rental income, absolutely can be offset by depreciation shield. Now, the government giveth and the government taketh. So 10 years from now, you have this real estate and the real estate is doing really well and you decide to sell it. Okay, so you've taken this depreciation shield, you've been feeling good, thumbing your nose about your real estate income. 10 years from now, when you sell it, all of that benefit you got each year in the depreciation, not all of it, but most of it is going to be recaptured. One of the nasty surprises is the recapture of depreciation. So if you sell your investment and let's say you paid 500,000 for it and you sell it for $1 million. So you would think, well, I made 500,000. Well, not so fast. You depreciated, let's say $100,000 of it. Now your cost basis or what you actually bought it for looks like it's 400,000. And that difference between what you bought it for and the depreciation, that's called depreciation recapture, and it's taxed at 25%. Okay. So that is just something you just need to be aware of. Now, there is something that you could do, and that's called a 1031 exchange. And a 1031 exchange can be a very powerful way to continue to not pay that tax on the capital gain. You can defer. That's what CPAs like to do. We like to defer. Pay your taxes never, but usually pay your taxes well into the future. The way to pay the taxes never is to die. So not such a great strategy, but something that will come for us all. So the important thing about the 1031 exchange for pilots is that before you sell the property, as soon as you think I might sell the property, learn about the 1031 exchange, because I can't tell you, probably now 35 times someone's called me and said, hey, I sold my property, we just closed, and I'd like to do a 1031 exchange. It's too late. It's too late. You must, before you sell, you have to set up all your ducks in a row to do the 1031 exchange. And the rules are, I wouldn't say they're real complex, but you just need to know all the rules. You need to have someone that's going to hold the money when you sell, and then your basis will be transferred over to the new property. So absolutely, again, for real estate purposes, the 1031 exchange is a very powerful tool if it's something you want to do. Now, you'll still have to be in the rental business. And so sometimes people sell out because they don't want to be in the rental business anymore. But if you still want to be in the rental business, but you find a property you think can cash flow even better, or you can make more money on, then that's a reason to do that. So I'd also like to talk a little bit very quickly about the self-directed IRA. That's something we get asked a lot because, a lot of pilots, a lot of people in general have the bulk of their wealth is in retirement accounts. So they want to use retirement accounts to buy real estate. The only comment I would have about that is that I would personally not do that. Okay. I would not do it just because there's self-dealing rules when it comes to self-directed IRAs. There's the possibility you could bust the IRA open and have to pay tax on all of it. There's valuation issues, and you have to use special companies. And just do a quick Google search on self-directed IRA companies and see what the reviews are. A lot of people are unhappy with the fees that they pay, and then the possibility sometimes of not being told certain things that are not permissible. That's another expression that I hate to hear. When something's not permissible in an IRA, that means it blew up the IRA. Setting up an LLC. Again, many times we get asked, hey, should I set up an LLC for my real estate? That's going to be a benefit to me. I can then deduct the expenses. And LLCs are really asset protection vehicles. Also, you can look at getting insurance for asset protection, but LLCs are typically disregarded entities when it comes to real estate and tax. So LLCs really don't help when it comes to saving tax on real estate. So one of the other really interesting factors, and again, this is more of a thinking holistically about your wealth, is that if you're going to sell real estate in the future, you have a big embedded capital gain. Embedded just means that looks like you're going to make money on it. So one of the things you can do in a brokerage account, taxable account, if you will, is start harvesting losses. Harvest losses, harvest losses. You know, direct indexing is something we as a firm are very interested in because you can systematically harvest losses at a lower level than just doing ETFs or other funds or stocks. They do the stocks for us and they harvest losses. But if you're harvesting losses along the way, when you do sell the real estate, that might be a way to go ahead and sell it and have less capital gains. You still have the depreciation recapture issue, but I think that's a really good idea. So coming back to this real world example of a pilot who's flying, and let's say it's a captain, okay, a captain making $450,000 with ordinary income that's actually spilling between salary, spill cash that comes out, and paying over $100,000 of tax, maybe even state tax, and says, I want to get into real estate because I want to save on taxes. If we come over here to the real estate category, you can see that, again, there's a line here. Now you could, you know, if this real estate is going to make you money, the tax benefits are there for just the real estate itself. You could harvest losses along the way in your stock funds. That would be good when you do eventually sell it. You could make money in real estate. Again, capital appreciation in the real estate is not something you pay taxes on each year. You defer. You could do the 1031 exchange, but this is going to be really two worlds apart here. You have your ordinary income from your work, and then you have your real estate from your real estate. They are two different worlds of taxation. So if you have any feedback, if you have any questions, please reach out to us. We are we are financial planners at Leading Edge. We are wealth managers, but we also know that tax is a huge part of building wealth in America because taxes are taxed on income. They're not just taxed. They're not taxed on wealth. They're really taxed on income. So we're here to help. Thank you so much for watching.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.